Hello, everyone. Welcome to this episode of Expert Speaks. It has been quite some time. Markets are not showing any direction to go down or to move up. They have been stuck in a range. So, this calls for checking what exactly happens in the marketplace right now. What is the valuation of the market? Are the markets ready to break down? Or the markets are passing through a stagnant phase? What lessons we have from the history of looking at the past years of performance of the Sensex? So we are going to talk to expert of the week, Mr. Chirag Patel, to get all the answers you could be having in your mind. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Are you an NRI living outside of India for more than 10 years? Have you dreamt of a retired life in India in a beautiful house and a lifestyle of your choice? Your dream can come true only when you take some simple and effective actions today. I will take you through a step by step process to make this dream come true in my webinar Stress Free Retired Life in India. Hello, I am Dr. Chandrakant Bhatt, financial guide and founder of YouTube channel NRI Money Clinic. I have to my credit creating secured retired life for thousands of NRIs spread across more than 60 countries. If you have an intention to make your dream retirement come true, register for my webinar. More details are in the link below. Dear viewers, to take you through the subject of the valuation of the market and what you should be doing from here onwards, based on historical perspectives, based on the valuation one sees in the market, to help you today, we have the expert of the week, Mr. Chirag Patel. Mr. Chirag Patel is co-founder of Valuemetric Technologies Limited. It's a company which is in the business of valuation-based analytics, helping the institutions to frame their strategies to advise the clients. It's a B2B platform. Mr. Chirag Patel comes with a very rich experience of working in asset management companies. He worked for 15 long years with ICICI Prudential Mutual Fund as the head of product specialization. Subsequently, he worked with White Oak Capital for 3 years as co-head of products. And subsequently, now they are on their entrepreneurship journey of Valuemetrics. We are also one of the beneficiaries of receiving the research reports from them to advise our clients. Welcome to this episode, Mr. Chirag Patel.
Thank you. Thank you for having me here. It is always pleasure to join to your channel and have a conversation with you. So again, thank you very much.
Chirag, I am entrusting you a major responsibility of guiding my investors who are lost, not knowing what needs to be done. So everybody saw a massive bull run and suddenly there are breaks. Then you have all kinds of news which is coming from Trump and everyone. As a researcher and as an experienced person who has designed the products, help people guide in their investment journey, how do you see the valuations of market today? What is your assessment of market as things stand today?
So we all know what is valuations, how the valuations are being measured. So people use various parameters like P, PB, market cap to GDP, right? Yield ratio, BR ratio. These are the ratio which are being used to measure the valuations. But one thing that we need to understand that we also need to see the state of the economy when you are looking at valuations. So for example, lower valuations 10 years back when the economy was not in good shape, and today slightly higher valuation when the economy is in good shape can't be viewed at the same parameters, right? So first we need to understand what is the state of economy. So just to help you to simplify it, I'll share a simple slides which can help you to understand what is the state of the economy. So this is the slide which I would like to share. So the economy can be into various zone or various phases. For example, we can have a booming economy where GDP growth is higher than inflation. For example, a 6-7% kind of GDP and 3-4% kind of inflation is called a booming economy. Then what is an overheated economy? Overheated economy is GDP is good, but now inflation is even higher than the GDP growth. So this is the stage where actually central bankers start intervening. They start raising interest rate to curb the inflation and again try to get back the boom state. But what will happen in this process? Sometime economy may move to different direction. Sometimes it may go to the slowdown because it will reduce the GDP growth and also it will reduce the inflation. So both GDP growth and inflation will start feeling southward direction because of the central banker action. Sometimes what will happen that you generally raise interest rate to curb the inflation, but inflation will not come down, the growth will come down. That phase is called stagflation, right? So these are the various state of economy. What is an inflationary economy? You will have rising prices and you will have strong demand. So inflation has started rising rapidly and you still have good GDP numbers. And what is recession? When you have consecutive 2 quarters of negative GDP, which you have witnessed during COVID time. So when you look at valuations, it is very important to see which kind of economic state your economy is currently into. So currently our GDP growth is close to 6-7% and our inflation is between 2 to 3%. So we are actually into a booming economy. What called as a higher valuation for a slowdown economy may not be the same thing for a booming economy. So we need to see them differently. If I have to club all this parameter, so for example, the state, what is the economic state of India and what are the valuation parameter? Currently, we are trading at fair valuations, right? After whatever has happened in last 9 months, we are trading at a fair valuation than what we were 9 months before. So that is what is the valuations.
So, what's your message to the average investor today? Should he invest? Should he postpone? How should finally he should take an action at this point of time?
9 months back, when all around there were good news, market was booming, the Sensex was at 85,000. Everyone wished to buy Indian equity, small cap, mid cap, defense stocks, everything, right? Then we started getting bad news. For example, FI outflow, rupee depreciation, first round of Trump and tariff news. Then there are geopolitical issues, wars at various parts of the world, and market started correcting, right? So overvalued market has actually came down to a comfort zone. During this period, what has improved? Number one, the bond yield has gone down. The GST collection has improved. The earning growth has been there, right? So if you see, the other economic parameter has only improved. So if I have to put it into the context and if I have to give you some guidance, what I can say you is through this chart, this is the state of various state of economy. These are the valuations band, right? So economy can be into stretch valuation, fair value plus, fair value, attractive or cheap zone. And the valuation economic state can be stagflation, recession, slowdown, inflationary, booming or overheated economy. So generally people wait for a big discount, but generally you can get big discount when the economy is not good. So for example, if in any shop there is a good demand by their customer, why should they give discounts? Currently, we are into a booming state of economy, right? So the market generally trade between fair value plus and fair value band. Hardly you will get any discounts. So if you are waiting for a very cheap market, it is highly unlikely that you will get into a booming economy. What at the best one can get is an attractive valuations. And when you get an attractive valuation, when there is a problem around the world, right? So without problem, how can you get a discount? For example, if there is a car dealer, right? And if there is a good sales happening across the month, why he should give you discount? So when there is a slump in sales, then it will give you discount. So the problem for someone is opportunity for someone else. Because of problem that the world is facing, for example, the world is facing a problem of low GDP growth and high inflation. So which is called stagflation. In some part of the world, there is a slowdown. In some part of the world, there is a negative GDP. India is the only country where GDP growth is high and inflation is in control. And because of world problem, you are getting FII outflows. And because of those outflow, you are getting discounts. So we want discount, but we don't want problem. That is what is our issue. And what is our habit? What we have learned during the schooling, you should do anything in life based on clarity. So for example, if you get all the clarities after 1 year, the market would be at all-time high. Before 4 months, there was highest level of uncertainty. Sensex was trading at 73,000. Then one by one, few clarity came and the market is today trading at 80,000. And if you want for more and more clarity, you end up investing at higher valuation. So if you want to invest at good valuations, right, at discounted market, you should embrace uncertainties because that can give you discount. But what we have studied in the school, that one should invest when you have a lot of clarities. And so most of the investor invested higher valuation. So when you are 30-40% sure, you should start investing based on valuation rather than news. So that is what is my message to the investor. Indian economy is booming economy. You won't get big discounts. And if you get some discount, it won't last long. So that is
Hmm.
what one should look.
See, you talk about the market valuation. When you talk about the valuation, what is the metrics you really look at as a researcher?
So, for example, as I have told you, we look at economy as a whole. Then we look at various valuations parameter. It can be a market cap based parameter. It can be a relative valuation based parameter. It can be a bond yield, right? Government bond yield. So, like falling interest rate will always help the economy. Why it will help the economy, and your economy will actually command higher premium at falling interest rate. Why is it so? For example, the interest rate is say 6%. So fixed deposit rate, to put it in simple, is 6%. What will you do? You will not do fixed deposit. Rather than you spend money, right? Your home loan rate, interest rate will go down. Your future car loan interest rate would be lower. So people will consume more at lower interest rate. And if you consume more, the economy will grow at a faster rate. So lower interest rate is just like a paracetamol for the economy. When we get sick, 80% time, the medicine will cure your problem, which is paracetamol. So lower interest rate act as a paracetamol for the economy. For example, when the COVID happened, there was huge repo rate cuts, right? And even there was a lockdown till November 2020, the market has recovered in the lockdown because the interest rate has fallen by a great deal. So bond yield was 5.9% at that time. So it will help the economy to recover at the faster rate, right? And the economic growth will be continued. Today, the world is facing a problem of hiking interest rate. We have cut the repo rate thrice in this calendar year only. So these are the various valuation parameter like price to earning multiple, price to book multiples, market cap to GDP, beer ratios, which is yield divided by earning yield. These are the ratios that we look at while we define what is the current valuation of the market, and again club it with the overall economic state. So that is what is the metrics that we use.
You have been in a practicing line of product design, studying the market valuation for over 20 decades in the midst of handling these things. You yourself are a researcher. You have dug into every bit of statistics of the market. During your research, have you looked at similar phases which have happened in the past? Is there any lessons to be learned from the history on this phase?
So I can tell you the experience has become curse nowadays because we have never seen this kind of economic state in our lifetime, neither you, neither me. Right? The
Yes.
reason is it is a booming economy from last 3 years. If you see from 2010 to 2013, we were into stagflation. Then 2014, 15, 16, we were into inflationary economy. Then 17, 18, we were into slowdown because of all NBFC crisis, demonetization, and implementation of GST, which has happened simultaneously. Then we had COVID. Now, if you see, if you have gone through those 11 years, right, we were never having a habit of booming economy. Now we are going through a booming economic cycle, right? And we have not seen it for a quite a long time, where GDP growth is intact, inflation is in control, current account deficit is in control, fiscal deficit in control, GST collection is rising, power consumption is rising, right? On a continuous basis. So the experience has become curse nowadays,
Hmm.
right? And new wise investors are doing very good because they have not seen such a bad days, because most of the millennials have seen Harshad Mehta, they have seen subprime crisis, they have seen taper tantrum, finally they have seen COVID. So for them, this kind of economic state is a new thing. So what I can tell you, if you have to learn from the history, you also need to unlearn from the history based on the current economic state. So this economic state is, or economy is very different from what we have seen 10 years back or 15 years back. This is a very growing economy. It is growing from demand growth. It is also growing from the productivity gain. These are the two metrics which is helping us.
One of the observations I have made looking at the past 30, 40 years of stock market is when the markets go through a massive bull phase, the
Mm.
subsequent period will be a lull period, prolonged period of no action or market downtick, market not moving anywhere. We have just come out of that huge market up move in the last between 21 to 23, 24 period of time. Do you think a similar repetition might happen, or it's just we should neglect this observation?
So I am not in a favor that completely neglect it, but I am having an opinion that we haven't seen any phase where we can say a bubble kind of thing has formed, right? So if I have to show you through some past bubble, so these are the various bull run, which has converted into the bubble. And if you can see, this is that Harshad Mehta bull run, where earning growth was just 24% and market was up by 215% CAGR in just 1.5 years. So this is called a bubble. The PE multiple was 57 at that time, at the peak. This is
Mm,
your Ketan Parekh bull run, where the return was 88%, where the earning growth was down and PE
mm,
multiple was high. It was a tech bubble, which we how we have defined it in past. This is an emerging market bull run, right? Where earning growth was 25% CAGR and earning growth was 36% CAGR. PE multiple was 29. This was the longest bull run we have seen, right? This is from 2005 to 2007. Then this is the economic reform phase where earning growth was just 5%, but market was up by 12%. So whenever there is an overvaluation, what is the observation? The returns are higher than the EPS growth or earning growth. But if we see everything from the COVID bottom, it would look like a very big bull run. But if we see before and after that that bottom, the return from Sensex is 15% and the earning growth from that period is 21% CAGR. So if you see the earning growth is higher than the return, which makes the valuation comfortable today. And if, for example, last 1 year, the earning growth has been slowed down because before that, we have got good earning growth from 2021 to 2024, right? So this is the phase where we have good earning growth. Now we are slightly behind that high earning growth period, but it is a moderate growth period. And I think after those rate cuts in last 6 months, we have three rate cuts. There is a good budget, which is consumption oriented budget, where tax slab rate has been increases from 8 lakhs to 12 lakhs, which will again further boost consumption. I think the future earning growth would be higher than what we are witnessing today. So I think this bull market is just a consolidation phase. It is not a bubble. Yeah, there are bubble in the some segment of the market like small and mid cap and in defense. But in overall market, as far as large caps are concerned, there is no bubble. They are trading at fair valuation. So I don't think it should be compared with the previous bubble, and market would take a big breather, like 5, 6 years or 3 years. It can be a some level of consolidation. We have already passed through 9 months, so it is a significant period for this kind of economy. So I think that good days are ahead. That is what is our reading.
Okay, I'll take your word for it, Chirag, and all of us will celebrate if the markets were to move up because we also get tired of answering the customers what's happening in the market, why it's not moving. See, this is a period where everybody wants quick returns. 2 minutes noodles, instant coffee, quick
Yeah,
fix solutions, right? So we'll be very happy to do it. Can I ask you a simple question? If the markets were to go up from here, one of the learnings of the past is that two bull markets will not have the same leadership. So
exactly.
whenever the next bull market happens, let's leave out the time zone. But in your opinion, which sectors are likely to perform better, and how does it works out as a contrast to the previous bull run?
So basically, after every fall in recovery, the different segment of the market will outperform, right? That we have seen. Currently, if you see that there is no issue with the domestic economy and domestic news, whatever happening across the world because of tariff or war is to the export oriented businesses. So I think one should look at where the valuation comfort is there and where there is a high growth probability and whatever steps that has been taken around the last 1 year, which would benefit it. So I think banks, financials, consumptions and auto, these are the three sector where valuation is comfortable or attractive, and there is a high growth probability also in times to come. So these are the sector I think they should lead the recovery. And as an investor, one should look at this kind of sectors, and one should look at large caps and larger mid caps rather than complete small and mid cap, because they are still going through very stretch kind of valuations.
Let's say we have an aggressive investor who is prepared to give a 5 to 10 years time horizon. Nevertheless, we all say a proper asset allocation is the right strategy to go when you start investing. What's your formula for an aggressive investor who has 5 to 10 years period of time? What is the kind of asset allocation he should go through? You can also add a message for the rest of the people, like a person with moderate risk appetite or conservative investors. As a researcher, can you give me a quick fix asset allocation model for them?
So generally, when we spoke about aggressive investor, they consider themselves, I should put 100% into equities. But if somebody has read a book called Intelligent Investor by Benjamin Graham, he has mentioned in his book that an enterprising investor should put 75% into equities. And if we have done this study in last Indian market, a portfolio with a 75% equity has actually outperformed portfolio with 100% equity with lesser risk. So most of the time people talk about high risk, high return, but which is not the right statement. You should be able to moderate your risk and still you would be able to generate higher return, right? So by hanging on the train door, you can't reach at your destination faster, right? So you have taken higher risks, but you will not reach earlier. So nowadays, what people think that, okay, they are emotional about putting money into small and mid caps. So when I ask them why you want to put into small and mid cap, because I wanted to take higher risk. Actually, you wanted to take higher return. And for that, you should take a calculated risk. That should be the right answer. So my first suggestion is to have 70-75% equities on your overall asset allocation. That is the first thing. Then you should fall in love with any market caps, right? By increasing your risk, you may not end up increasing your return all the time. You should love your money, not the sector or funds, right? So that is one thing. So when someone told me that I wanted to put money into small and mid cap, so he's emotional about it, right? He's not rational about. Your objective is to get higher return. That is fine, but why you need to take higher risk? Sometimes the risk premiums are not there. I'll explain how the risk premium works. I'll again share my slide which can easily explain those concept of risk return. So this is your risk return matrix, right? This is the x-axis is risk and the y-axis is return. If you take zero risk, you will get some return which is called risk-free rate of return, which is 10-year bond yield return, which is 6.4% as on today. If you increase your risk, your return will increase. That is what is the general conception. So for example, if I have increased my risk from this point to this point, my return will increase from this point to this point, right? So that is what is general assumptions. But those risk premium are not similar all the times, right? So for example, in this chart, if you are increasing the risk by 2 unit, your return is increasing by 1 unit. So you are not equally compensated for increasing your risk, right? And so when it is happened, when there is a bullish market, the positive sentiments are positive and market is overvalued. And overvalued market, even if you increase your risk, you may not end up increasing your return in the similar fashion. But in undervalued market, when sentiments are negative, which is currently, when you increase your risk by a 1 unit, you end up increasing your return by 2 units. So you can still take a moderate risk and increase your return. So this is what is the concept of risk adjusted return. That is what I would like to convey, that you should find out good growth at bargain price. That is what is the mantra for creating wealth. And my suggestion, put 70% amount into equities, prefer large cap equities within that. And whenever there is a valuation comfort in other segment of the market, you should increase allocation at that time. So rather than predicting the market, you should prepare your portfolio. And sector-wise, one should remain overweight in banking, auto, and consumption. These are the sectors where an investor should remain overweight as compared to the benchmark. That is the way to create alpha, and you can meet any kind of, you can tackle any kind of risk which are unforeseen in nature.
Where does gold stand in this case? Do you have a view on gold?
So it is a very difficult asset class to value because it doesn't have any cash flows, it doesn't have any PE multiple, it doesn't have any earning growth, right? So generally when the uncertainty increases, the gold trade at higher valuation. And when the clarity increases, gold trade at lower valuation. Today there is high level of uncertainty, so gold has already risen. And that's why it is not an undervalued asset, right? It is slightly overvalued asset class. So if the market turns toward clarity in next 1, 2, 3 years, you will make more money from equities than gold.
Thank you, Chirag, for this clarity you have provided for our investors. You have made their life much simpler, given clarity, and made us understand what valuation about it, what valuations the current markets are quoting, and how the phase what we are passing through has no similarities any time in the past. So it's an uncharted territory where you have markets not moving up. However, the economy, conditions, everything are favorable. We just have to pray, and the season should commence at an appropriate time. That's the message I would like to pass on to the investors. We remain in gratitude to you for your kindness to share all your experience, thoughts, and your research findings for the benefit of our community of NRIs. Thank you very much, sir.
Thank you. Thank you for having me.
Dear viewers, hope this video helped you to understand what you should be doing, how you should control your equity exposure, how you should not be perturbed by what's happening, the noise around, and single-mindedly focus on investing with a proper time horizon, rest, the time will take care of itself. If it helped you to understand the simple investment philosophy, do give me a thumbs up. Those of you who are yet to subscribe for the channel, please do hit the subscribe button and press the bell icon. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the social media on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another topic, with yet another expert next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.